You think a recession is more likely now than maybe you would have said 6 months ago?
Well, I think most of our managers would say that they are surprised at where they are now compared to how they thought they were going to feel 6 months ago at this point.
What's coming is worse than a recession. Warren Buffett's last warning. Warren Buffett, one of the most respected investors in history, recently shared something that should make us all pay attention. When asked if a recession is more likely now than 6 months ago, his answer wasn't comforting. He admitted that even experienced managers are surprised by how things have unfolded. What they expected 6 months ago is very different from the reality they're facing today. It's as if we're standing on the deck of a ship with calm waters and clear skies ahead. But just beyond the horizon, a storm is forming, one far more dangerous than we realize. Buffett isn't just concerned about a recession. He's preparing for something potentially far worse, and his actions speak volumes. He's been selling billions in stocks and hoarding cash like never before. This isn't just market noise. It's a clear signal that something big is coming. So, what's this storm, and why is Buffett sounding the alarm? Is it simply another market fluctuation, or is there something deeper at play? In the next few minutes, we're going to break down Buffett's warnings and what they mean for you, your investments, and your financial future. But before we dive into the details, take a moment to ask yourself, are you truly prepared for an economic crisis worse than a recession? Stick around, because what you'll learn next could make all the difference. And if you find value in this content, be sure to like, share, and subscribe. The warning signs. Rising cash reserves, a beacon in the fog. Let's take a step back to the early 2000s during the dot-com bubble. Many investors were riding the wave of booming tech stocks, convinced that the future could only go up. But in the midst of this frenzy, one man was quietly amassing cash, preparing for the bubble to burst. That man was Warren Buffett. Fast forward to today, and we see history repeating itself. Buffett's Berkshire Hathaway is sitting on an unprecedented cash reserve of $168 billion. But why? What does this enormous cash pile signal in an economy that seems, on the surface, to be thriving? Buffett's cash hoard isn't just a financial strategy, it's a glaring warning sign. When the world's most successful investor starts liquidating assets and holding on to cash, it's time to pay attention. This isn't the first time Buffett has prepared for a storm, but the scale of his actions now dwarfs anything we've seen before. The last time Berkshire's cash reserves were this high was during the 2008 financial crisis, a time when Buffett famously swooped in to buy distressed assets at bargain prices. Today, with cash reserves far exceeding those levels, Buffett seems to be signaling that something big, something potentially catastrophic, is on the horizon. But what exactly is Buffett waiting for, and what should you be doing with this information? Stick with me, because we're about to dive deeper into the signals he's sending. The unprecedented stock sales, a strategic retreat. Picture this. You're on the battlefield, and your most seasoned general suddenly orders a retreat. Not a small one, but a full-scale withdrawal of the troops. This isn't a sign of fear. It's a calculated move to avoid unnecessary losses and prepare for a more advantageous position. This is exactly what Warren Buffett has done with his recent stock sales. In just one quarter, he sold over $77 billion worth of stocks, including a massive reduction in his Apple holdings, once the crown jewel of Berkshire's portfolio. To put this in perspective, this is the largest amount of stock Buffett has ever sold in a single quarter. For years, Apple made up nearly half of Berkshire Hathaway's equity portfolio, a testament to Buffett's confidence in the tech giant. But now, by reducing his stake by nearly half, Buffett is sending a clear message. He believes the market is overvalued, and the risks of holding on to these assets outweigh the potential rewards. This strategic retreat isn't about cutting losses, it's about preserving capital for future opportunities. Buffett is positioning himself to buy when others are forced to sell. The shift from speculation to safety, lessons from the past. Let's rewind to the roaring 1920s, a time of boundless optimism and reckless speculation. The stock market was booming, and it seemed like everyone was getting rich until they weren't. The crash of 1929 was a harsh reminder that markets can turn on a dime, and those who ignore the warning signs often pay the highest price. Fast forward to today, and we see echoes of that same speculative frenzy. Young investors, lured by the promise of quick gains, are pouring money into stocks, cryptocurrencies, and other high-risk assets, often with little regard for the underlying value. Warren Buffett, however, has always been the voice of reason in times of irrational exuberance. He's seen the dangers of speculation firsthand and has consistently advocated for investing in solid, fundamentally sound businesses. In recent years, Buffett has been increasingly vocal about the dangers of the current market environment, likening it to a casino where people are more interested in betting on the next big thing than owning pieces of real businesses. Buffett's shift from growth stocks to safer, more stable investments isn't just a defensive move, it's a strategic pivot that reflects his deep understanding of market cycles. By prioritizing safety and liquidity, Buffett is preparing for a potential market correction that could leave speculative investors reeling. But how can you apply Buffett's lessons to your own investment strategy? As we continue, we'll delve into practical steps you can take to safeguard your portfolio in these uncertain times. Why this time is different. The end of easy money. A turning point. Imagine living in an era where money seemed almost free. Interest rates were near zero, borrowing was cheap, and governments were flooding the economy with cash to keep things afloat. For the better part of the last decade, this has been our reality. It's a world where businesses thrived on easy credit, consumers spent freely, and the stock market reached unprecedented heights. But like all good things, this era of easy money is coming to an end, and the implications are profound. Warren Buffett, with his unmatched experience, recognizes that the financial climate has changed drastically. The Federal Reserve has hiked interest rates from nearly 0 to over 5% in just over a year. This isn't just a minor adjustment, it's a seismic shift in economic policy that has far-reaching consequences. Higher interest rates mean higher borrowing costs for businesses and consumers alike, which in turn reduces spending, slows down growth, and puts pressure on asset prices. The days of easy money are over, and this new reality is something that even seasoned investors must navigate carefully. Banking pressures and the looming credit crunch. Let's take a moment to reflect on the 2008 financial crisis, a time when the collapse of major financial institutions sent shockwaves throughout the global economy. One of the key triggers was the strain on banks, which had overextended themselves with risky loans and investments. Fast forward to today, and while the circumstances are different, the underlying pressures are eerily similar. The recent failures of Silicon Valley Bank and Signature Bank are stark reminders that the banking sector is under significant stress. Higher interest rates have slashed the value of banks' fixed-income portfolios, leading to massive losses. At the same time, depositors, lured by higher returns elsewhere, are pulling their money out of banks in droves. This exodus is putting further strain on financial institutions, forcing them to tighten lending standards or even pull back on lending altogether. The result? A potential credit crunch that could suffocate businesses and stifle economic growth. Warren Buffett sees the writing on the wall. He knows that when banks start to struggle, the ripple effects can be devastating, leading to reduced access to credit, slower economic activity, and ultimately a recession. But what's more concerning is that this time the situation could be even worse. The economy is already fragile, and a credit crunch could be the tipping point that sends us into a full-blown economic downturn. Speculation versus value. A market on the edge. Consider this. During the height of the dot-com bubble, companies with little more than a website and a dream were commanding billion-dollar valuations. Investors, caught up in the euphoria, poured money into tech stocks with no regard for their actual value. It wasn't long before the bubble burst, wiping out trillions of dollars in wealth and leaving many investors in financial ruin. Today, we're seeing a similar pattern of speculative behavior, but on an even larger scale. Buffett has always been a champion of value investing, buying strong, well-managed companies at a fair price and holding them for the long term. But in today's market, value is increasingly being overshadowed by speculation. From meme stocks to cryptocurrencies, the allure of quick profits is drawing investors into increasingly risky ventures. Buffett's concern is that this speculative frenzy is setting the stage for a major market correction. When the dust settles, those who have invested based on hype rather than fundamentals could find themselves facing significant losses. This isn't just idle speculation. Buffett's actions speak volumes. By selling off large portions of his stock portfolio and holding on to cash, he's signaling that the market is dangerously overheated. The economic outlook. Recession risks. A perfect storm on the horizon. Think back to the Great Depression of the 1930s, a time when the global economy came crashing down, leaving millions unemployed and countless businesses shuttered. It was a perfect storm of economic factors: overproduction, declining demand, and a catastrophic stock market crash. Today, many economists and market watchers, including Warren Buffett, are sounding the alarm that we could be heading into another perfect storm. Though the circumstances are different, the underlying risks are eerily similar. The current economic landscape is fraught with potential pitfalls. On one hand, we have the remnants of a pandemic-era economy that was buoyed by massive government spending and ultra-low interest rates. On the other hand, we now face the reality of rising interest rates, inflationary pressures, and an increasingly unstable global market. Buffett has warned that these factors could converge, leading to a recession that might be deeper and longer lasting than what we've seen in the recent past. But what exactly does this mean for the average person? Higher interest rates are already making it more expensive to borrow money for homes, cars, and businesses. Inflation is eating into household budgets, reducing purchasing power, and squeezing profit margins for companies. When combined, these factors could lead to a sharp decline in economic activity, rising unemployment, and a significant downturn in the stock market. It's a scenario that Buffett is clearly preparing for, and one that investors would do well to heed. Market correction. The inevitable downturn? Imagine you're at the peak of a mountain, enjoying the view, unaware that a storm is rapidly approaching. The stock market, much like that mountain peak, has been climbing higher and higher, fueled by years of low interest rates and speculative fervor. But as history has shown us, what goes up must come down. Warren Buffett's recent actions suggest that he believes the market is overdue for a correction, a significant drop in stock prices that could wipe out trillions of dollars in wealth. Buffett's view is grounded in the principle that market cycles are inevitable. There's a rhythm to the markets, where periods of exuberance are often followed by periods of correction. The challenge is that timing these cycles is incredibly difficult, even for seasoned investors. But one thing is clear, the longer the market climbs without a meaningful correction, the more severe the eventual downturn is likely to be. For investors, this means being prepared for the possibility of a market pullback. Buffett's strategy of increasing cash reserves and selling off stocks is a clear indication that he's positioning himself to take advantage of lower prices when the market eventually corrects. Global economic shifts, the domino effect. Consider the global economic landscape as a complex web of interconnected dominoes. When one domino falls, it sets off a chain reaction that can impact economies around the world. We've seen this play out in recent years with supply chain disruptions, trade wars, and geopolitical tensions creating ripple effects that have destabilized markets. Now, with rising interest rates and inflation, we're seeing new pressures that could trigger further economic shocks. Warren Buffett has often emphasized the importance of understanding global economic trends and how they impact domestic markets. Today, those trends include rising debt levels in emerging markets, the ongoing energy crisis in Europe, and the uncertain future of major economies like China. These factors create a highly volatile environment where a single event, like a financial crisis in a major economy, could lead to a global downturn. For investors, this means paying close attention to global economic indicators and being aware of the risks that come from abroad. Diversifying investments and staying informed about global trends can help mitigate some of these risks. But more importantly, understanding the potential domino effects can help you make more informed decisions about where to allocate your assets. So, what does this all add up to? The economic outlook is fraught with uncertainty, and the risks of a downturn are growing by the day. Warren Buffett's actions are a clear signal that now is the time to prepare for what lies ahead. What you can do. Prudent investing, weathering the financial storm. Picture yourself as the captain of a ship, navigating through stormy seas. The skies darken, the waves grow, and you know there's no turning back. What do? You prepare. In the world of investing, Warren Buffett's recent actions serve as a blueprint for this preparation. He's battening down the hatches, and you should, too. The first step is adopting a strategy of prudent investing. This means focusing on fundamentally strong businesses that can weather economic downturns. Buffett always emphasizes investing in companies with strong balance sheets, consistent cash flow, and a durable competitive edge. These companies thrive even when the broader economy falters. By concentrating on such businesses, you can reduce the risks of market corrections. But what makes a company resilient? Look for businesses with low debt, diverse revenue streams, and a history of surviving past recessions. Industries like consumer staples, healthcare, and utilities are more stable during downturns. Consider adding them to your portfolio as a buffer against volatility. In times of uncertainty, it's not about chasing the highest returns, but preserving your capital and ensuring steady growth. Focus on fundamentals, the Buffett approach. Imagine you're at a yard sale hunting for treasures. You wouldn't buy something just because it looks shiny. You'd want to know its true value. This mirrors Warren Buffett's value investing philosophy, which focuses on fundamentals, not hype. Focusing on fundamentals means doing your homework. Analyze the companies you invest in. Look at earnings reports, management teams, industry positions, and long-term growth potential. Buffett's approach is timeless. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This holds especially true in volatile markets. The companies built on solid foundations will endure, while speculative investments may falter. Companies with strong brand recognition, loyal customers, and adaptability are often best positioned to survive downturns. By focusing on fundamentals, you can identify these gems and invest with confidence, even when others panic. Avoiding speculation, a time for a caution. Reflect on the Dutch tulip mania of the 17th century. At its height, a single tulip bulb could be worth as much as a house. When the bubble burst, fortunes were lost overnight. Today, echoes of this are found in speculative markets, from cryptocurrencies to meme stocks. In these cases, prices often bear little relation to true value. Warren Buffett's recent moves signal the importance of avoiding speculation. In times of economic uncertainty, the lure of quick gains can be strong, but also incredibly dangerous. Buffett always warns against following the crowd, especially when driven by hype. The key to long-term success in investing is patience and discipline. How can you avoid the pitfalls of speculation? Start by questioning the underlying value of your investments. Are you investing based on solid research and long-term potential, or simply chasing the latest trend? Speculation isn't limited to meme stocks or crypto. It can also creep into traditional markets if you're not careful. Securing your financial future. As we conclude this journey, consider the story of Noah's Ark. Faced with a coming flood, Noah didn't wait for the first raindrop to fall before he started building his ark. He prepared well in advance, knowing that early preparation was essential. Warren Buffett's recent actions are a signal for us all. Now is the time to build our financial arks. Throughout this video, we've explored Buffett's strategies, accumulating cash, retreating from overvalued stocks, and focusing on fundamentals over speculation. The risks of a recession, potential market corrections, and global economic shifts amplify these challenges. The critical takeaway? Preparation is key. Preparation isn't just mental, it requires action. Reassess your investments, focus on strong businesses, and avoid speculative ventures that could lead to big losses. Diversify your portfolio, stay informed, and be ready to act when market opportunities arise. The decisions you make today will shape your financial future for years to come. Your next steps. Now that you have this knowledge, it's time to take action. Review your current investments. Are they aligned with the principles we've discussed? Are you holding on to risky assets, or are you positioned to take advantage of opportunities in a market downturn? If you're unsure, seek advice, do your research, and make the necessary adjustments. And as you take these steps, don't forget to stay engaged with Economy Explorer. Like this video, share it with those who could benefit, and subscribe for more insights to help you navigate the financial landscape. With the right preparation, you'll be ready to weather the storm and come out stronger on the other side. Remember, the storm is coming, but with smart decisions, you can protect your investments and thrive. Start building your ark today. Until next time, keep learning, stay proactive, and make wise choices.